Good afternoon, everyone, and welcome to this webinar with Bellevue Healthcare Trust. The theme of the week is investing for retirement. For the fortunate amongst us, this still means investing with a long-term time horizon. And in our view, healthcare, the growing need for it, its growing sophistication, and the support it has from global wealth levels and demographics is a long-term investment theme with a lot of potential. Shortly, we'll be hearing from Paul Major, co-manager of Bellevue Healthcare Trust. As always, we have roughly 25 to 30 minutes set aside for the presentation, and then 15 minutes or so for questions. Please put any questions for Paul in the box on the right, and I will ask him those at the end. So, Paul, over to you.
Thank you very much, Thomas, and good afternoon, everybody. So, as Thomas alluded to, I manage the Bellevue Healthcare Trust along with my colleague Brett, and our product is a concentrated portfolio approach to investing in change within healthcare, and it combines a bottom-up stock picking approach with a top-down thematic overlay. And I will explain that overlay and the opportunities that creates within healthcare in a moment. But essentially, we can summarize it up front as we think the healthcare systems of the developed world are fundamentally challenged, and they need to be reinvented to be made fit for purpose to serve the needs of an aging population. So let's talk a little bit about how healthcare works from a demand and supply point of view, and what some of those challenges currently are. So in many ways, I have probably one of the easiest jobs of any investment manager in the world, which is to explain why healthcare demand will grow inexorably for as long as anyone cares to forecast into the future. And there are 3 or 4 key drivers of that. The first is the obvious one, which is there are ever more people in the world, and becoming ill is an inevitability, an unavoidable inevitability of life. But there are some other factors to bear in mind. The first is the aging of the population. As you can see in the bottom left-hand side of this slide, unfortunately, medical progress at the moment means that aging is unavoidable and inevitable, and decrepitude follows that. So what you generally find is when you get to middle age, which is where I am now myself, you find bits and pieces start wearing out, and you have increasing burden of what we call chronic diseases. So chronic means it can't be cured, it has to be managed for the rest of a patient's life. And you can see there in the bottom left hand side how basically as we reach retirement age, where we generally cease to be paying as much in tax revenue, we also become extremely expensive in terms of managing the burden of those chronic diseases. And there are various lifestyle and other factors that come into this. So for as long as anyone wants to forecast into the future, we will see increasing demand for healthcare. On top of the aging population and the rising population, we also have increasing wealth around the world. Once you have a roof over your head and food in your belly, you have the opportunity to worry about staying well. So as countries reach advanced economy status, we start to see healthcare spending growing as a significant proportion of GDP. China, for example, is only really in the beginning of that broadening out of the healthcare system into a national infrastructure situation. So it's something that takes a while, but can generate very, very significant growth in the future. And then finally, on top of that, we have ever ongoing R&D opening up new avenues, new opportunities to improve the human condition. So all of that is fantastic. But if we take a step back for a minute and we look at the world we live in, the UK is very unusual in terms of how its healthcare system is put together. And for those of you that are aware of the continuing deification of the NHS, you might ponder the question of, if our healthcare system is such a wonderful idea, why has no other country chosen to copy the same system that we have? There's a lot to consider within that. But if you just look at this chart, this takes you back to the beginning of the NHS on the left-hand side versus a couple of years ago today. And you can see how the causes of death have changed over time. And it used to be the case that the NHS was there to patch you up during an acute episode. So you'd had a heart attack, or you'd had some sort of horrible infectious disease like tuberculosis or some other bacterial type infection. And they would manage you and then hopefully get you back on the road, and you carry on with your life. And as you can see, we don't really have that burden of infectious disease anymore. You know, the pandemic was a very unusual period, but generally speaking, people don't really die of infectious disease, and they don't really die of heart attacks in the same way that they used to, because we have preventative care and we manage people over a longer period of time, blood pressure medications, atrial fibrillation drugs, etc., stents, cholesterol lowering drugs, all these things that you'll be aware of that have greatly reduced the burden of heart disease and stroke in the broader population. So what this means is you're around for a lot longer, which means you cost a lot more to look after, and then you end up dying of much more complex, much more expensive conditions like cancer and dementia, which obviously require significant amounts of care. And this presents a tremendous challenge to us all, which is evidenced on the next slide, which for some reason, sorry, bear with me a second, I can't seem to advance the slides. Sorry, we seem to be having a bit of a technical issue here. Let's see if I can do it manually. There we go. So here are some examples of the challenges that we face as a consequence of this ever-growing demand. This demand will rise inexorably regardless of what the economy does, because when people get sick, it's got nothing to do with recessions or booms or anything else. And you can see that illustrated on the left-hand side here. This is the health expenditures in the United States rising inexorably regardless as to whether the economy is growing or flatlining. Healthcare expenditure just goes up and up and up. And governments are not very good at thinking about this or dealing with it. And you'll probably be aware that the NHS has exceeded pretty much every long-term budget forecast anyone has ever chosen to put in place. And we tend not to put out forecasts in quite as much detail as the Americans. So in the middle, you can see some data from the US, and what you can see, with the exception of inflation in the short term more recently, healthcare cost inflation has significantly exceeded general inflation for any year you want to look back, and will continue to do so for pretty much the majority of years looking into the future. So what this means is if we carry on as we are with the same kind of healthcare system that we have, even assuming that we can scale it because of all the labour shortage and other things that you'll be aware of, these are international problems. They are not UK specific problems. When you read about not having enough doctors and nurses, it's the same in every developed country pretty much. Healthcare is going to consume an ever greater proportion of our wealth, which is obviously unacceptable to society, particularly given that the burden of paying for that is falling on an increasingly smaller number of people as the dependency ratio increases and the population ages overall. Now, when we look at healthcare expenditure, this is also a remarkably inefficient industry because it's totally outcomes driven. Once you enter a hospital, they're going to do everything that they possibly can to keep you alive, even if actually that's not what you've requested in your own personal will or whatever. That they have taken an oath to do everything they possibly can. So what you find is tremendous amounts of unnecessary expenditure. You also find that because we all self-refer into the system, so if you think about the last time you yourself used the healthcare system, you probably decided you didn't feel well and you sought the help of a physician. Now, in many cases, they turn around and say, there's nothing wrong with you, or we don't think there's anything wrong with you. Go back to getting on with your life, and hopefully you'll feel better by yourself in the coming days and weeks. And actually here in the UK, 1 in 4 interactions between a patient and a doctor are deemed not medically necessary after they've taken place, and it's the after that is the problem. But you can see here on the right hand side just some examples of the waste that goes on, but broadly across the globe it's reckoned that $1 spent in healthcare is wasted to no medical benefit to anybody. And when you think about this being a $10 to $12 trillion global industry, that is a significant amount of capital that could be redeployed into improving services, or just the whole thing costing all of us a lot less money than it does today. So when we look at where does that money go, so this is an example from the US. Now, if you have been a successful investor in healthcare equities in the past, you will have made the vast majority of your money from investing in novel pharmaceutical products, novel drugs, and novel medical devices. Now, if we look at this chart, you can see that actually prescription drugs are a tiny proportion of overall health expenditure, and the medical products bit is within the light green part there. So where we've made our money historically is in about 15% of the healthcare pie, and generally speaking, we haven't had the opportunity to invest into products and services in the broader environment. and therefore we haven't really had the opportunity to participate in the change in healthcare that's inevitable and necessary in order to make this system work for all of us. And what you can see overwhelmingly here in the two blue areas which make up the majority of healthcare expenditure is it's that interaction between the patient and the physician, particularly when it's unnecessary or overly complicated, where there's tremendous opportunity to save enormous amounts of money. So let's move on to think about the healthcare system as it exists today. Sorry, I'm having another technical problem here. Let's move this along. There we go. Right. So this is a pictographical representation of the modern healthcare system. Now, hopefully, you're all happy, safe and well at the moment, so you will be sitting in that green box on the left-hand side. But the reality of life is that your inherited genetic characteristics about which you can do nothing, certain lifestyle factors, you know, smoking, drinking, not exercising, eating the wrong foods, unfortunate accidents, you could walk outside and get hit by a bus or whatever, or just the sheer passage of time, as we've talked about, decrepitude is sadly also inevitable. You will at a certain point have some kind of symptoms that cause you to seek the help of the healthcare system. Generally, you would go to your GP in the first instance, and you would receive some kind of diagnosis. Now, sometimes that diagnosis is very simple, sometimes it's complicated. It requires you to access all sorts of tests or scans or other things like that. But eventually there will be a treatment plan laid out for you. Now, in the vast majority of cases, that treatment plan has two key characteristics. The first is it's symptomatic relief. So what the doctor wants is for you to feel better and go away and stop bothering them. It's often not that they treat the underlying cause of your illness, it's that they treat the symptoms of your illness and hope that your body will heal itself, or they accept it's a chronic medical lifelong condition and they're going to medicate you to manage that for the rest of your life. Rarely is it actually a curative intervention. So antibiotics for an infection, or you know, getting a cast on a broken up bone, for example, they're kind of curative interventions in the sense that afterwards you wouldn't expect to receive any kind of ongoing care. Now, you will hopefully recover as a consequence of these interventions, but as alluded to earlier, 75% of all the healthcare expenditure, 80% out there, is related to managing these chronic conditions in the aging population. So it is a certainty that your symptoms will ultimately come back and require additional interventions, additional medication or whatever. So you go round and round in circles. Now, on this slide, you can see 21 bullet points. Each of those bullet points is a product, technology or service that exists today and has been demonstrated to do at least one of three things: improve the quality of care for the patient in that particular part of the patient journey, lower the cost of care, or enable the caregiver to make better decisions on behalf of the patient. Because often, if you think about care, it's a series of binary decisions as to what you do next. And this is probably the most important slide in our presentation. This really informs how we do what we do, how we think about the healthcare system. What we are trying to do with Bellevue Healthcare, forget benchmarks, forget geographies, forget subsectors of healthcare. We are seeking in a balanced way to maximize operational gearing in the companies that we invest into the bullet points on this slide. And that in essence is what we do, because these are the things that we've identified as being able to make the single biggest inflections to that cost and efficiency dynamic within healthcare. But once again, I cannot seem to move the slide in a second. There we go. So what this means in practical terms is that we end up with a portfolio of investments that looks very different to what you'd find if you bought any kind of an ETF type product, or most of our peer group healthcare funds, which tend to be very diversified, so 60, 70, 80 companies in the portfolio. We've averaged 30 over the lifetime of our product. And they tend to be dominated by mega cap companies that you'd have heard of, the Pfizers, the Johnson & Johnsons, the Glaxos of the world. We're not interested in those diversified conglomerate-like companies. We like small, focused businesses that are operationally geared into the areas that we've identified as being critical to transforming healthcare. And we've illustrated some of the companies that we either own currently or have owned historically in the portfolio, and the particular bullet points that they address. And hopefully the one thing you're taking away from this slide is I haven't heard of many of these companies, and that is in many ways the whole point of using a specialist investment fund. In terms of product characteristics, that leaves you with a product that looks very different to what you would do historically in terms of concentration, in terms of geographical exposure, and in terms of correlation to any kind of benchmark. So a couple of things to say. You'll see our fund is very, very tilted toward the United States. There are a number of reasons for that related to innovation, regulatory oversight, availability of venture capital, and the fact that the healthcare system is more for profit on the provider side in the US than it is anywhere else, which means that there is a bigger incentive and reward for investing in innovation and improving efficiency than there is anywhere else. And that's why our fund is very geographically exposed to the US and why we would expect it to remain that way for the foreseeable future. But critically, you can see in terms of market cap exposure, the benchmark is overwhelmingly dominated by a small number of mega cap companies. In contrast, we have very little mega cap exposure in our portfolio, much more in the kind of small mid cap area, owning the next generation of kind of disruptive and innovative companies. Now, before we talk about performance and opportunities in the market today, I think it's worth just spending a second on considering just how strange and unusual today's stock market actually is. So here is a chart which I'm sure many of you have seen something like this over time. This is basically looking at the United States S&P 500, the principal index in the US, and it's breaking it down into what's known as the Magnificent Seven, which is those seven technology-oriented stocks, including the automotive manufacturer Tesla, which I mean isn't really a tech company, but we'll leave that to one side for a second, and the rest of the index. And what we've seen in the last sort of 2 or 3 years is almost unprecedented. We haven't seen a market so concentrated and so dominated by a small number of very, very large companies since the early 1970s. Now, I feel very old, but I'm not old enough to have been working in the early 1970s. In fact, I wasn't even born. But anyone who is familiar with that period of history will be aware that we had something very similar in the early 70s in the US, when the market was dominated by the so-called Nifty 50, and that was followed by the 1973 stock market crash. So lots of people are talking about, is the equity market overextended? Are we into some kind of a bubble? I would say, in order to consider that question, you probably do need to think about the performance of these 7 stocks versus the performance of the rest of the market. And that's what I've tried to disaggregate here. So we have, in white, we have the Magnificent Seven, we have the S&P 500 in orange, and then in yellow, we have the S&P 493, as it's called. So that's the other bit of the S&P 500 that isn't the Magnificent Seven. Now, as you can see, since the kind of tech breakout in early 2022, the rest of the stock market hasn't really done very much. And if we look at it on a forward multiple basis, it's actually a very reasonable looking 22 times, which is not cheap by historical standards, but it's not expensive either. Contrast that with the 39 times forward PE of the Magnificent Seven stocks. Now, what's driven most of this breakout by tech, as I'm sure you're very familiar with, is excitement over machine learning, artificial intelligence systems. And everybody is seeing huge amounts of capex from mainly these very large companies going into buying chips from NVIDIA to build this generation of AI capabilities that are allegedly going to transform the economy. Again, I do feel very old. I was around for a front row seat for the 98, 99 tech frenzy, followed by the 99-2000 tech crash, which was a very painful experience for anyone caught on the wrong side of it. And yeah, we've been here before. Stock markets have a real tendency to get very excited about technological change and over extrapolate the consequences of it. So I remember Booking.com in 1999, how everyone said, one day everybody is going to book all their travel online and nobody will ever use a traditional travel agent. Well, here in 2024, that's absolutely true. And Booking.com has finally got a share price that's higher than what it was in 1999, but we are obviously many decades on from that frenzy. And I remember Cisco Systems. So everybody's excited about NVIDIA, saying, NVIDIA chips are going to build the AI revolution of the future. This is probably very true, at least in the short term. Back in the internet age, it was Cisco Systems and their routers that everybody was excited about. And they said, this is the picks and shovels of the internet age, and you have to own this stock. It's never got back to the price that it sits at, or it sat at back in March 2000, which is the peak of the tech bubble. So I think investors need to make a decision to the regarding the extent of how much exposure they want to have to indices dominated by tech and tech in general. But the other point about all of this, of course, is the interesting consequence of the rest of the market hasn't done very much. And does that therefore mean that within the rest of the market, there are some interesting opportunities? And this concentrated market dynamic, unusual mega cap focus, that has also played out in healthcare in the same way. So traditionally in healthcare, if you were to look back over any reasonable period of time, multiple decades, what you'd find, unsurprisingly, in an innovative growth sector, is that the small mid-cap indices outperform the big cap indices. So if we go back to the S&P 500 that we just talked about, for example, if you go from the S&P 500 to the S&P 400, which is the mid-cap one, to the S&P 600, which is the small cap one, every gradation down you went in an index, what you'd find is around 100 basis points of annualized performance incrementally delivered. Yes, you get a bit more vol, but you get a lot more performance. Now, in historical periods, you get market uncertainty, market volatility, and often the small mid-cap elements draw down faster than the rest of the market. But it always recovers quite quickly, or at least that held true until we got to Q4 of 2021. And this is illustrated on the slide in front of you. And what we've seen is a decoupling of small and mid-cap performance from large cap performance. This is within healthcare, very similar to the dynamic we've seen in the broader market. And that creates a really interesting investment opportunity because this simply can't hold forever. And the reason it can't hold forever is because of what it means in valuation terms, which is illustrated on the next slide. So it's worth thinking about in the period before 2022. And by the way, we did have rising interest rates as well, not anything like the cadence we've had recently, but nonetheless, we had rising interest rates during that period. Valuations, forward valuations are roughly about 25% lower today than they were back then. So the market has gone up, but the market has been driven by a small number of large cap stocks. In healthcare, it's been things like Novo Nordisk and Eli Lilly around excitement over obesity. And what this has meant is that much of the rest of healthcare, or much of the small mid-cap area in the broader market, has done very, very little. And we think that offers a tremendous opportunity for investors as we move into a more kind of rational market environment, particularly as we approach the likely period when interest rates start to get cut. And again, many of you will be very aware that tends to lead to outperformance from growth stocks and from small mid-cap equities. Now, you could, of course, say at this point, well, that's great. Well, why don't I just ignore your fund, go buy an ETF? Sorry, bear with me a second. I'll come back to this. Go buy an ETF in a small mid-cap healthcare index. And you could do that, but we tried to illustrate on slide 14 why actually you want to use an active manager in this period, because healthcare is innovation driven and there is always an element of risk, developmental risk, regulatory risk around these sorts of companies. So stock picking is important. So as we've demonstrated on this chart, we've outperformed, even during this challenging period, we've significantly outperformed an index of small mid-cap healthcare. Now, within the different sectors of healthcare, one of the things that's really fascinating is that actually, if you look at the areas that have underperformed the most relative to historical valuation, you can see it's on the right-hand side of this chart, it is actually the ones that are most exposed to artificial intelligence in reality that have actually underperformed significantly or been derated significantly. And it's some of the much more traditional areas where they're much less sensitive to innovation that have actually done very, very well. So distributors and generics in the global sense, they're both very low value added industries, lower margin, but they've held up very robustly during this period. And then you've got, of course, diversified therapeutics, which is those big pharma companies. Hospitals, areas where you wouldn't necessarily think innovation is quite such a driver. So that brings us to performance. There's no shying away from this. Our strategy performed incredibly well. It was class leading within global healthcare from inception through to the middle of 2021, and then 2022 was an extremely challenging period. 2023 was a bit better. We did outperform the market, but not by very much. And we are continuing to focus. We haven't changed our focus. It's very much on those kind of small mid-cap companies. And we think that the market is due a repositioning. It can't. We cannot continue forever to focus on such a narrow number of companies. And I think when we're in a broadly more supportive macro environment, people will come to realise the valuation growth and innovation opportunity presented by these kind of small mid-cap healthcare stocks. And we think that we're due, as illustrated on the earlier slide, quite a material re-rating, possibly not just 25% of our portfolio in terms of valuation, but beyond that, this is a portfolio, even if the valuation doesn't change, the growth is so high that it should accrete value on a sort of teens annualized basis anyway, because these companies grow so quickly. So let's just have a quick look at what we have in our portfolio. So again, hopefully in many cases you can see lots of companies you think, I'm not sure what they do. That's kind of the point of a specialist manager. But I think the more interesting thing from our point of view is to look at the right hand side, which is comparing our subsector allocation to what you'd see if you bought an ETF on the MSCI World Healthcare. What you're seeing there is that we are making absolute advantage of that unconstrained mandate we have to diverge from the broader market on an opportunity and a risk adjusted basis. So we don't have those generics companies, we don't have hospital operators, which is facilities, we don't have those distributors, we don't have conglomerates or diversified therapeutics. We have much less exposure to managed care, which is insurers. Where we're focused is biotechnology, which is focused therapeutics, novel medical technology, novel diagnostics, companies providing services that enable the healthcare system to outsource and be more efficient, which is services, and then healthcare IT and healthcare technology. Healthcare technology is wearables, basically, and we're very much innovation and growth oriented in terms of our portfolio. One final thing to leave you with before we move to Q&A, which always comes around every 4 years or so, which is this discussion about, can you own healthcare when there's a US election going on? Now, what you generally find in US elections, there's this kind of view that there's an axiomatic truth that healthcare doesn't work during election years. And this chart, which is courtesy of Goldman Sachs, illustrates that that's not really true. So what you can see is the blue area is showing you the aggregated performance of healthcare through election cycles. And broadly speaking, relative to the market, it doesn't do anything positively or negatively during elections. Politicians do talk about healthcare quite a lot because they're obviously trying to attract the marginal swing voter. There are very few things that really talk to everybody in the US, given it's such a polarized political environment there these days. But most people don't like health insurers and they don't like drug companies. They believe they're being ripped off. So if you talk about those things, you generally get good column inches, lots of positive comments from voters. So you generally find during the primary campaign, particularly, that you get lots and lots of noise around healthcare. But the reality is healthcare is very difficult to reform and most of the politicians have focuses elsewhere. So what you tend to find is later in the campaign, they tend to talk about other things. We call that the great walk back. So during the early phase, during the primaries, you get a lot of noise about healthcare and then it dissipates away. But it's created this impression, which isn't true, that you can't own healthcare because it will underperform during an election year. Of course, this is a very unusual election year because there isn't really a primary campaign. Biden is the sitting president. We know what his agenda is. It's the current one, just another 4 years of the same. And then Trump is Trump all over again. So an even Trumpier version of what we had before. He's been very clear about what his policies are. And what's interesting about both of them is there's very, very little focus on healthcare. So we've tried to illustrate that on the next slide. So you can see here a bit of background on what the discussions are, and you can see what the policies of Biden and Trump are, and they are very, very benign toward healthcare. I think one of the most interesting things is that you would generally think a popularist like Trump would be very anti-government welfare programs, entitlement programs, and because we are talking about healthcare being predominantly used by the elderly, social welfare programs, Medicaid, Medicare, retirement stuff, which is what Medicare is, would potentially be at risk. But in fact, Trump has gone out of his way to say that he doesn't think that retired seniors in the US should bear the burden of paying for the mistakes of the Biden administration. And therefore, effectively, he's committed to not attacking Medicare, which is the single most important part of the healthcare ecosystem in the United States. So the government actually pays for about 50%, just over 50% of healthcare expenditure in the US. So as far as we're concerned, the political environment is very benign. So if you take a step back and summarize everything I've said, we've lived through a very unusual couple of years. I think the focus has been away from small mid-cap equities, and as a consequence, a lot of innovation has gone unrewarded, leading to a situation where valuations in that area are very attractive. And healthcare, generally speaking, has not attracted generalist investor enthusiasm as much as it would ordinarily do, because it's been overshadowed by the technology sector, particularly over the last 12 months. So what that means is we have a bunch of companies here that are attractively valued, very robustly supported from a demand point of view, and we have, broadly speaking, a benign political environment. So I think if you are considering what you could invest in for long-term compounding, high-quality defensive growth, then looking at healthcare is no bad thing. And with that, I'm very happy to open up for some questions. And thank you.
Brilliant. Thanks, Paul. We have a few questions already coming in, but please, if you're in the audience, please ask away. We should have time to go through everything. So on the small cap underperformance, do you think then that it's interest rates that is likely to be what would change this dynamic, or is there something else that you think would cause mid caps to start to outperform?
I think there are two or three things. So healthcare can be quite complicated, and often people are investing in things and they sort of say this feels very, very technical, very regulatory, hard science. I need a reason to kind of look through maybe some of the complications to invest in this, which I don't understand as well, rather than something that I do. And there are a couple of things there. So FOMO is big in this sector as in any other. I think when you're seeing lots of hot IPOs, when you're seeing lots of M&A happening, people think I've got to own these things because there's a lot of action going on in the sector. And because of the Biden administration's approach to antitrust, and because of the general market situation, with the IPO window looks like it's been closed for quite some time, and maybe with Reddit, it's the first signs that maybe it's opening up a bit, and so I think people have felt unconcerned about potentially ignoring this. But to answer your question, Thomas, I think interest rates are the primary issue here. So whenever you're buying a growth equity, one that's consuming large amounts of cash, you have to think about a couple of things. So the first is, what's the right discount rate? The second is, if this company runs out of money and needs more cash, will it be able to come to investors and get more easily? And I think those two things have coalesced to create a reluctance to invest in healthcare, be it profitable or not. So interest rates rose very, very quickly, faster than they have done in a very long time. And when things are rising fast, people say, well, I don't know when the end is, so I'll just apply a big number. So what we wrote about this in a couple of our fact sheets over the last few years, but in order to justify some of the valuations that we've seen in recent years, you'd have to start applying teens discount rates, which is pretty unprecedented, except for very early stage companies. And we don't invest in very early stage stuff. And then I think the second thing is investors pushed out, if you look 2 or 3 years ago, investors were generally happy to invest in a company as long as, if it was loss making, as long as it had at least 12 months of operating cash in the bank. Now that's more like 2 years. So any company that's within that 12 to 24 month period of potentially running out of cash is attracting a punitive risk discount attached to it, because people are worried about the financing environment. Now, January and February saw very robust inflows into biotechnology companies. We saw a lot of secondary raisings coming through and being completed quite successfully. So I think there's a couple of things here. The first is clearly interest rates going down definitively draws a cap on what's the right maximum rate I should use, and that will help to illustrate the value there. I think if the market starts to open up, people will realize that they don't need to apply that secondary discount around future financings. And I think that will help a lot. And then the fact that these companies will then start to perform will create the FOMO situation. And then lots of generalist investors will get off the sidelines and say, I need to look again at my healthcare exposure and maybe be less underweight healthcare than I have been for the last couple of years. Because the critical point about that is that if you're a very long-term investor, you wouldn't have taken any money out of the sector. You'd have put more in with these low valuations. But if you're a generalist investor, you've looked at these and you've said, right, I've been underweight healthcare for the last 2 years, but you know what? That hasn't hurt my performance. So I'm fine with that. And until I see a reason to change that, I'm probably going to continue.
Great. And I guess in the healthcare sector, it's been the GLP-1 drugs that have driven the outperformance of Novo and Eli Lilly. Could you just kind of briefly explain your view on those?
Sure. So obesity is a bit of a complex issue. So this is all very, very new. And the reason it's very, very new is prior to these drugs being approved specifically for weight loss, which is effectively something that's only been the case for 18 months, there's never been a safe way to lose a large amount of weight quickly. So certain questions that have been answered by general science haven't been asked by doctors about looking after patients, which is, how fast should you lose weight? How desirable is it to lose weight? Is it desirable for everybody to lose weight at the same rate? How long do you stay on these drugs? What happens when you come off them? All these sorts of things. Now, GLP-1 drugs are absolutely marvelous. They're particularly marvelous for younger people. I'm thinking of men probably below, say, 60s and premenopausal women. When you get beyond that, we all have a natural tendency to again, this decrepitude thing that I keep referring to, depressing as it sounds as a topic, we all start to suffer from wastage as we get older, and you have a propensity to lose muscle, and if you're a woman, unfortunately also lose bone mass, osteoporosis, unless you work very hard to stop those things happening. And the only way to stop that is to maintain regular amounts of physical activity. Now, if you lose weight, you will lose fat, but you also lose lean mass, and that means your organs, your muscles, and your bones. The faster you lose weight, particularly from a drug that stymies your appetite so you don't eat, the faster you will lose lean mass. And so these GLP-1 drugs, they're marvelous, but the idea that people can be on them for a really long time, and the idea that they're suitable for everybody, or that it's great to lose weight, 15, 20% a year kind of range. Do a bit of Dr. Google, look at long-term studies, because these drugs have been around for diabetic patients for about 20 years, and start looking at things like sarcopenia, which is muscle wasting, or osteoporosis, which is loss of bone tissue, or what happens when you come off them. So obesity is a massive problem for society, huge costs associated with it, excess mortality. Obesity is ever more prevalent in every country. 38% of adults in America, according to the CDC, are pre-diabetic, for example. So we are sitting on a healthcare time bomb. There are about 220 conditions that are linked to obesity. What I mean by that isn't necessarily caused by obesity, but if you have obesity, it makes the outcome worse. So we do need to address this. And I think we can see lots and lots of things in the future which are multimodal, so they hit lots of different pathways within the biology of why you gain weight and stuff, that could be very compelling with regard to obesity. What I don't see personally is 5 or 10 years from now a market where obesity is dominated by the use of GLP-1 drugs, firstly, and secondly, one where the market share is overwhelmingly dominated by Eli Lilly and Novo Nordisk, to the extent that the market's currently assuming. So what does this mean? We think the obesity opportunity is real. We think it's very significant, and we think this could be one of the largest classes of pharmaceutical products ever seen in the world. We don't own any Eli Lilly anymore. We did own it once. And we don't own any Novo Nordisk. Not because I don't believe in these drugs, but I just don't believe that the sales forecasts required to justify the share prices of those two companies will be realized in the way that the market does. We are very interested in this area, but we're looking at other companies with more multimodal approaches to the treatment of obesity.
Great. We had a few questions on geographical exposure that might kind of tie together. So why are you so little exposed outside the US, and in particular in Europe? You appear to have no exposure to Europe. Could you just talk us through that?
Yeah, sure. We have had exposure to European companies in the past, so there's no reason. So we're agnostic to geography, right? But every opportunity you have to look at as a combination of the quality of the company, and then you have to look at the valuation. Now, because there is this tendency in all areas of human society for concentration. You know, you go to Hatton Garden, there's hundreds of jewelers, and you would think maybe from a competitive standpoint it doesn't make any sense, but actually the benefits of being close together outweigh those competitive things. And you see that in healthcare. So the capital markets in America are more sophisticated when it comes to healthcare. As a consequence of that, if you are one of these early stage companies recently floated on the market and you're looking for additional capital, it's very, very easy to find investors who are well educated about what you're doing and can understand your aims and objectives and value your company accordingly, and risk adjusted accordingly. That is harder in Europe. I'm not saying there aren't many specialist investment funds in Europe. There are, but they are few and far between. You know, Bellevue is one of a very few healthcare-oriented European-based investment companies that runs a diverse range of healthcare investments, and the US is completely different. There are hundreds and hundreds of these people, right? So what that means is if you're thinking about where to list your shares, the US makes a lot of sense. So a lot of the companies that are listed in the US are not even necessarily based in the US, and we have several companies in our portfolio that are listed on NASDAQ, but actually based somewhere else, or historically based somewhere else. I can think of two that we have in the portfolio at the moment, and several historically, where actually they started out in the UK, but tragically, UK investors were not prepared to support the growth plans of the company, so they had to go to the US, and in many cases they transferred their listing. So the US is a very sophisticated market, and that also applies to venture capital. So about 90% of all the venture capital dollars available for healthcare in the world are in the United States. So if you are, again, a startup company, even in Cambridge, UK, which is, as I'm sure you all know, is a hotbed for healthcare innovation globally, you're going to be going to US people to fund your company. And when you're involved in early stage funding, you get seats on the board and you get to exercise control. And so the gravitational pull towards America just becomes almost unavoidable. So for the foreseeable future, we see the cradle of innovation in capital markets being the United States. The regulator there is also far more sophisticated with regard to supporting early stage companies than anywhere else. One of the things, I can't think of many, but one of the things that's potentially a huge positive for UK PLC out of Brexit actually relates to this point about regulation. So when we were part of the European Union, the regulator of novel drugs was actually based in London, in Canary Wharf. That moved to the continent as part of Brexit, but most of the people that worked there were Brits. And so we have an incredibly sophisticated, well-staffed regulator here in the UK. And they've taken a very, very flexible and pragmatic view to effectively cherry picking regulations from other parts of the world and trying to support innovation here in the UK. That's why, for example, we were the first country in the world to approve a pandemic vaccine, because our regulator can move very quickly if it wants to. So I am hopeful that the UK's position with all of this will begin to improve, and the NHS is very keen to support innovation. But we don't have the venture capital here right now to kind of back that up. So that's why the US is such a powerful force. And then I think because there's so much scarcity around good European healthcare companies, they tend to trade at higher valuations than the US ones. So again, if we see, if you compare Siemens Healthineers, who make MRI machines, CT scan stuff, with GE Healthcare in the States, right? Siemens generally looks more expensive. So rationally, you're going to allocate more to kind of the US ones as well for that reason. So we do have exposure to Asia, but Asian markets have been challenging from a diligence point of view, and obviously China as well, with everything that happened with the COVID lockdowns, which were just incredibly draconian, and that set back the development of their healthcare system by many years. So I think we remain interested and open to investing anywhere, but the US is just, there's just so much there, and such an ecosystem to support it around it. It gives you a level of confidence it's very difficult to get elsewhere. I hope that answers everybody's question.
Definitely. We had a question about your research facilities, your resources, and do you share those with your colleagues in Switzerland, where you have a similar trust, by which I think they mean BB Biotech?
Yeah, sure. So the simple answer to that is yes and no. So the trust is a legal entity in its own right. So the intellectual property, for want of a better word, belongs to the trust. So we do all our own work, but obviously we collaborate with our colleagues and with others where we see that it makes sense to do so. Now, one of the benefits of being part of the bigger Bellevue family under the Bellevue umbrella, for want of a better word, is, you know, Bellevue's been a healthcare oriented asset manager since 1993. It was doing biotech back in the early 90s before most people even knew what biotech was. And as a consequence of that, it has a tremendous reputation within the industry as a sophisticated and supportive long-term holder. So what that means for us is that if we email a company and say we would like some time with your CEO or CFO, regardless of who they are, we will generally get that time with the C-suite executives, which means from a diligence point of view, from a market education, you know, because we don't just look at companies we want to invest in, we also look at all the private companies and anybody who's innovating in the sector, so we can have as much confidence as possible that our longer term view on how the market's going to develop is the right one to have. And being part of Bellevue from that perspective is absolutely invaluable. But our approach, I mean, for example, there's lots of different funds and lots of different approaches within Bellevue. Our approach and that of the biotech fund are somewhat different in the sense that we're a diversified healthcare company, healthcare investor. So we invest across lots of different sectors. We're a conviction investor, which means that we don't invest in very early stage things where there isn't clinical data to analyze. In contrast, our colleagues on the biotech side, they will go very, very early. So they even invest in private companies sometimes, and they will invest in very early clinical stage data, which we just wouldn't do. So the addressable universe that if you think about them having a Venn diagram of biotech, and then you think about biotech as a subsector of healthcare, and then you lay the two over, the overlap would actually be very small.
And you mentioned you won't invest in early stage biotech, but do you ever invest in unprofitable companies? And if so, what percentage of the portfolio roughly would be unprofitable?
Sure. So around, I haven't looked at this for a few months, to be honest, but I think about 15% of the book currently is companies that won't be cash flow positive within 2 years. That doesn't mean to say they haven't got sufficient cash runway to see them through to profitability, but that's just measured on a P&L basis. So I would differentiate between early stage and pre-commercial. So for example, I'm sure most of you are familiar, there are effectively 3 stages of developing a drug. So, well, 4. There's preclinical, where you do experiments in animals and in test tubes and things to establish mechanism of action. You then, and toxicology and dosing. You then go into phase 1, where you optimize dose response. You then do a phase 2, which characterizes safety and dosing. And then you go back to the regulator with all the information you've got, and you design a phase 3 trial, and you try and size that and devise that. So it's going to give you clarity on safety and efficacy, and give you a measurable endpoint that can be described with statistical backing that the drug delivers some kind of benefit, right? So we wouldn't invest in something that wasn't phase 2A or above, because as part of our conviction investing strategy, we have to be able to demonstrate. Remember, our whole ethos, if you go back to that slide of the patient journey, everything has to tick this box of improving patient care or lowering cost of care. If you don't know the broad efficacy proposition of a drug, and you don't have a reasonable idea of its effectiveness, you can't do a cost effectiveness analysis. Therefore, it can't meet our criteria. Does that make sense? So we will invest in a pre-commercial company, which means someone who hasn't launched their drug on the market, we are happy to take a degree of binary risk around regulatory outcomes and developmental success. But we will only do that in a limited fashion. So generally speaking, if we invest in pre-commercial companies, they're not one drug, one product companies. There's generally a portfolio of things there that we have done sufficient work on that we can have a degree of confidence in them.
And sorry, I'll maybe give a last call for any questions from the audience. But picking up on that, would you take positions then in some of these non-listed companies?
We can't do so. One of the attributes of BB Healthcare Trust is that it has an annual redemption option as a discount control mechanism. And so what that means is that this is an ungated annual redemption. It happens every November. So we always need to be mindful of the liquidity of our portfolio. And so we took a view right at the start. Now, there are lots of very exciting opportunities in the private sector, the private markets we get to see, and I would love in the fullness of time to have a version of this strategy addressing private companies. I think that could be very, very successful. But we don't think the two should be mixed together, because I think people will question the validity of that redemption option. And I think, you know, Woodford and other strategies that have mixed public and private have really served to kind of queer the pitch for investment trusts around all of that. So we have liquidity criteria that are agreed with the board and monitored on a daily basis, and that's how we run our product. So there's no place within that for private companies. And when we invest in smaller companies, you know, generally speaking, we don't do stuff less than about $1 billion in market cap, or about $20 million a day in traded equity. Where we invest in things at the smaller end of that, the positions would be capped in size by those liquidity considerations. So we would hopefully never get ourselves in a position where there's something we couldn't sell out of if we wanted to.
Great, thanks very much, Paul. We did have a final question jump in about the dividend target. Are you still happy with your dividend target? Perhaps you could just briefly explain how the dividend works.
So most of these innovative companies won't pay dividends. So when we were setting this up, it was very clear to us that amongst retail investors in particular in the UK, where they had healthcare, it had been to things like AstraZeneca, GlaxoSmithKline, these large FTSE 100 pharma companies, and they actually pay outsized dividends. They're a big component of the FTSE 100 overall dividend yield. So it became clear to us very quickly that if we were asking people to do something different, we would need to make up some of that lost dividend income, because it was important to retail investors. So our dividend, you can consider our dividend to effectively be a manufactured dividend paid out of capital. There is a bit of dividend yield in the portfolio, but it's de minimis, and then you have to assign some of the cost to that. So effectively, it's a manufactured dividend. And at the time that we launched the trust, 3.5% was an attractive yield. Consequently, we felt that was the right thing to do. It's a decision for the board as regards what happens to the dividend in the future, but it's an aspect of the portfolio that maybe manufactured dividends. And for everyone, we have an open-ended version of the strategy that has an accumulating share class. So for people who don't want to pay dividends out of capital and just want pure accumulation, then we have an option for them as well. But what that means is that the dividend is very easily forecastable, in the sense it's set at 3.5% of NAV by the board. So I don't see any risk to the dividend in that sense, or that dividend policy changing in the foreseeable future.
Great. Thanks very much, Paul, for your presentation and the questions. And I would flag to the audience that fact sheets are very informative. There's a lot of commentary on the portfolio, much more than usual. So it would be it'd be worth reading the latest one. Thank you for everyone in the audience, and hopefully we'll see you at our next presentation tomorrow. And have a great rest of the day, everyone. Goodbye.
Thank you. Bye-bye.